Hello, friends. Hello, students. And good evening to all of you. So, today we will revise two very important topics from exam point of view. One is Penalties and Prosecution Black Money Act, and the second is Tax Audit and Ethical Compliances. See, these two are quite simple and not so big topics. And from exam point of view, generally, 4 to 6 marks question always asked in the recent attempts from each of these topics. But we as a student, I don't know why, even we used to do that. We used to leave this topic for some reason till the end of the syllabus. And ultimately, since the syllabus is too big, the exams arrives and we could not do this topic properly. So it's better. In today's class, we will discuss in the 3 hour class, we will revise complete these two chapters. And if not less, 8 to 10 marks paper is expected from this. And these 8 to 10 marks are really makes a lot of impact in securing an exemption or rank. So without wasting time, let's start. To introduce myself, C.A. Tarun Gupta. I will be taking your today's class. Okay. So our first chapter is Provision to Counteract Unethical Tax Practices. Meaning thereby, in this chapter, what we will study? We will study three things. First, the penalty. Second, the prosecution. And third, the black money act. Okay. So let's start with the chapter overview. So first we will study the penalty, then we will study the prosecution provision, not much important from exam point of view, and lastly the black money act. So firstly, which law is applicable on penalties? I mean to say, whether you will apply the law of the year in which the default commits, or whether you will apply the law of the year in which the penalty order is passed. So the law which was there, which was in force on the date on which the default commits, is the law which is applicable. So the penalty levied on the assessee is based upon the law as it stood at the time of default was committed, and not the law as it stands in the financial year for which the assessment is made. So clear? Now, see, the penalty are basically divided into two parts. One is the penalty for, we may say, underreporting of income or for concealment of income. The other are the penalties for other miscellaneous default. You did not get your books of account audited, you did not maintain books of account, you did not furnish the TP certificate, you obtain loan in cash and all this for specific events. But the major penalty, which generally arises in the case of assessment of income, is penalty under section 278. So, to give you a brief background, earlier to 278, there was 271(1)(c), which was a penalty for concealment of income, which is not applicable since, I think, AY 1718. So, with effect from AY 1718, we have 278. Under 278, there is a penalty for underreporting of income. Now you understand the underreporting as a big balloon. And if some of the conditions, we will discuss this in a minute, if some of the conditions, if the underreporting of income is on account of some of the prescribed conditions, then we call such income, which is because of such prescribed condition, which has been underreported because of such prescribed condition, we call such income as misreporting. So between underreporting, we classify some underreporting as misreporting of income. And the penalty on underreporting of income is 50% of the tax amount, tax on this underreporting. So penalty is always as a percentage of tax. So 50% of the tax amount. But if the underreporting is as a consequence of misreporting, then the penalty is 200% of the tax amount. Okay. So that section 270 capital A, penalties levied for underreporting of income, URI, which is 50%. But if the URI is because of the misreporting, then the penalty is 200%. So you're with me, my friends? Yes, sir. We are with you. Good. So who levies the penalty under section 270 for underreporting? So penalty can be levied by the AO or the JCIT appeal or CIT appeal or the commissioner or principal commissioner. How, sir? See, the basic law is the one who makes an addition to your income also proposes for the penalty. So the AO levies a penalty if the assessment order is passed by the AO, so generally the AO levies a penalty. But JCIT appeal and CIT appeal also has a power to enhance. So if they make some addition, in addition to the addition already made by the AO in the assessment order, they enhance the assessment, they enhance the income of the assessee. Now, the part of the income which enhanced by the appeal, the JCIT appeal or CIT appeal, they will propose the penalty on that income. The principal commissioner or commissioner can also increase the income of the assessee under section 263. We discussed this in the last class, revision. So if they are increasing the income of the assessee under section 263, then they will propose the penalty on the addition made by that. Okay. So under section 270, who levies the penalty? AO, JCIT appeal, CIT appeal, or the commissioner, principal commissioner. You understand how it flows. Now, when we say there is an underreporting of income, so very much logical. When will you say there is an underreporting of income? See, there's a company, A Private Limited. It furnished a return of income, say, for rupees 5 lakh. In the intimation, the income increased to rupees 7 lakh. Now, 143 scrutiny assessment, the income further increased to rupees 10 lakh. Now, the question comes, is A Private Limited liable to penalty section 270A? And if yes, then what is the amount of underreported income? So there is underreported income if the income assessed is more than the income return or income earlier assessed. Very much logical. If in the case of assessment, the income is increased than what the assessee has furnished in the return of income, then there is underreported income. You are with me? Very much logical. But if the income is increased in intimation, see, you remember intimation is not an assessment. If income is increased in the under intimation, also, why would an income would increase under intimation? It because of some arithmetical error or some inconsistency in the return of income. We discussed in the next class. Okay. So there is no assessment under 143(1). So on this increase of rupees 2 lakh, there is no penalty. The assessee is not required to furnish not required to pay any penalty, because intimation is entirely computer generated. No records are verified of the assessee and no hearing was done. So this 2 lakh is not regarded as underreported income, but this increase 3 lakh. So I have to compare the income assessed with the income under the intimation, not with the income in the return of income. Okay. So once the return of income is filed and the intimation is issued, then I will do my work. I will start only with the intimation. So in the intimation, it was 7 lakh. Now the income is assessed as 10 lakh. So there is underreported of 3 lakh. Now assuming subsequently another assessment, reassessment, the assessee the A Private Limited was again reassessed under section 147. And during the course in the assessment order 147, the income is assessed, say, rupees at 15 lakh. Then this 5 lakh, the income assessed minus income earlier assessed. So this 5 lakh shall again be treated as underreported income and be subject to the penalty. Okay. So it says when we say it's the case of underreporting income, when A is greater than B. Now what is A? Income assessed is greater than the income determined in intimation. When no return has been furnished, income assessed exceeds the basic assumption limit. So if assessee had not furnished any return of income, then of course there would not be any intimation. Then if the income assessed exceeds the basic assumption limit, then we will say that there is an underreported income. So this basic assumption limit is applicable only in case of individual HUF, AOP, BOI, or artificial judicial person. So if you are a company or firm, then if you have not furnished return of income and your income has been assessed, then whatever the income has been assessed shall be treated as an underreported income and you shall be subject to the penalty section 270A. So there's a reassessment. Then I'll compare the income reassessed with the income earlier assessed. Income reassessed with the income assessed or reassessed immediately before such reassessment. Okay. In case of company, there's a provision of MAD, and in case of other than company, there's a AMT. So if my assessment has been made on the basis of book profit in the case of MAD or adjusted total income ATI in the case of AMT, then I will compare this book profit or AMT or ATI with the earlier book profit ATI. If I had furnished return of income, the book profit ATI as determined in the intimation. If I had not furnished return of income, then the basic assumption limit. If this is the reassessment case, then I will compare the book profit of ATI computed in the reassessment with the book profit of ATI computed in the immediately earlier assessment. Okay, so similar as we discussed in the case of income. Also, there may be a case that the assessor furnished return of income and showed a loss of rupees 10 lakh. Now, in the assessment, this loss has been reduced to rupees 2 lakh. Is there an underreported income? Of course. You know, since the loss has reduced or if the loss is converted into the income, then there is an underreported income. In this case, the underreported income of 8 lakh. Had this 10 lakh loss been converted into 5 lakh income, then the underreported income would be 15 lakh. You with me? Because this 10 lakh, I will come to 0, then 0 to 5. So 15 lakh. How we compute the underreported income? It's very simple. Income assessed minus the income assessed immediately before this time, or income as per the intimation, or the basic assumption limit if the no return was filed. You're with me? So if return was filed, this is the first assessment. Then the underreported income will be income assessed minus income as per the intimation. If no return was filed, then the underreported income will be income assessed minus the basic assumption limit. Okay. And if it's a case of reassessment, then the income reassessed minus income assessed immediately before this assessment. So where it is furnished, the underreported income is assessed income minus income determined in the intimation. Where no return was furnished, then in case of company, firm, or local authority, the income assessed. Why? Because in this case, in case of company, firm, or local authority, there is no basic exemption limit. They are straightway tax on the fixed tax rate, 30%, 22%, whatever. So assessed income, in this case, basic exemption limit is 0. In any other case, assessed income minus the basic exemption limit. Where income is not assessed for the first time. So it's a case of reassessment. So income reassessed minus income assessed immediately preceding this reassessment. Income assessed order in the immediately preceding order. In case the assessment is made on the basis of book profit of ATI, then the underreported income is A minus B plus C minus D. What's A minus B? A minus B is the difference between the income assessed and the income return or income determined in the intimation under normal provisions. And C minus D is the book profit assessed minus book profit determined in the intimation. Okay. So A is income assessed under the provision other than the provision contained 115 JB. So under normal provisions. B is income that would have been assessed. Income determined in the intimation under normal provisions. Similarly, C is book profit assessed or ATI assessed, and D is book profit or ATI determined in the intimation. Okay, one important point here. I'll explain you with an example. Assuming there's a private limited. Okay. So it furnish a return of income and it offered income of rupees 10 lakh and book profit of rupees say 15 lakh. In intimation, this 10 lakh becomes 12 lakh and this 15 lakh becomes 20 lakh. Now in assessment, this 12 lakh, the intimation, the income under the intimation and normal provisions, becomes say rupees 15 lakh, and this 20 lakh becomes 30 lakh. That is profit. So underreported income is income assessed under normal provisions minus income determined in the intimation 12 lakh. So 3 lakh and plus C minus D. C is the book profit assessed 30 lakh minus book profit determined in the intimation 20 lakh. 10 lakh. So underreported income is 30 lakh. Okay. Now assuming case, there is an item which has been added in the normal computation in the 15 lakh as well, and while computing book profit as well. Say there was an item of rupees 1 lakh. Now this 1 lakh rupees item is a part of rupees 3 lakh and 10 lakh both. Right? So the law says in such case, you will reduce this 1 lakh from the book profit of ATL. So we will take as 9. So the UTI will be, URI will be 12 lakhs. Okay. Now there are some cases where the though the income has been increased in the assessment, but it's not subject to penalty under section 270. So there are cases where the AO increases your income in the assessment proceedings. So the income determined in the assessment, the assessed income is higher than the returned income, but still the penalty under section 270A is not liable. First, one of the cases is that where assessee offers an explanation. If AO makes an addition, but assessee offers an explanation that why he claimed that deduction. So assuming the assessee claimed a deduction of expense A, and in the assessment order, the AO disallowed this expense. It's not necessary that because of this disallowance, the penalty section 270A is initiated. Why? Assume the fact that assessee may have a vague explanation, like there was a Supreme Court decision which said that direct expense A is allowable expense. But subsequently, after furnishing a return of income and before the assessment, an amendment came. And such amendment retrospectively disallowed expenditure A and overruled the nullified the Supreme Court decision. And at the time of assessment, the AO applied the amendment because the amendment was retrospective effect, and disallowed the expense A. But the assessee had a valid reason to claim the expense because there was a Supreme Court judgment at that time when he furnished the return of income. At that time, there was no amendment. And at that time, the expense A was actually allowable. But subsequently, with the effect of retrospective amendment, the same has been disallowed. So therefore, in this case, though there is an addition, but assessee has a satisfactory explanation, and therefore 278 should not be initiated. And third point is same, that the amount of underreported income determined on the basis of estimates. So assessee made an estimate, but tax officer changed that estimate. Assessee estimated an expenditure to be 7%. Tax officer changed the estimate to 5%. So there's only error of estimate. In such case, the penalty is not liable. If the amount, the addition is on account of TPO order, transfer pricing officer. So there is a change in arm's length price. Then assessee had disclosed the international transaction, has computed an arm's length price. But now the transfer pricing officer has changed that arm's length price, and because of that, there is an addition in the income of the assessee. So arm's length price again an estimate, therefore no penalty under section 278. But keep in mind that the international transaction must have been shown by the assessee. In case of such, the penalty is not liable under section 278. The penalty is liable under section 271 AAB. So now I discussed with you in the balloon there is a part which we call misreporting. So if the income is underreported because of this 6 reason, any of this 6 reason, then it's a case of underreporting consequence of misreporting, and a penalty, higher penalty of 200% of the tax sought to be evaded shall be levied. Okay. So what are these cases? Misrepresentation of fact. Misrepresentation of fact means, it means you are driving professional receipts which ought to be taxed under section 44 ADA, and the minimum profit should have been 50%. But you offer this receipt as your business under section 44 AD and offer only 8% of the receipts as income. This misrepresentation of fact. Or there was a short-term capital gain. You show reflected as a long-term capital gain and offered a concessional tax rate. And in all these cases, there is a misrepresentation of fact. Or suppression of facts. You suppress some fact, you did not disclose. You fail to record investment in the books of account, or you claim expenditure not substantiated by any evidence, means bogus expenditure. Recording a false entry in the books of account. Fail to record any receipt. You make a sale, but you did not record it in the books of account, so your sales are understated. Or fail to report international transaction. You understand? If you fail to report international transaction, then it's a case of misreporting, not even the underreporting. Then you will be liable for 200% penalty. But if you have disclosed international transaction and the arm's length price has been changed on account of TPO order, then no penalty. Either 200% or no. Okay. Now, in case of underreporting, 50% of the tax sought to be evaded, tax payable on underreported income. In case of misreporting, 200%. So how we compute the tax on which this 50%, 200% is to be applied? Let's understand with the help of an example. Say I furnish a return of income with the income of rupees 10 lakh, and in intimation also it was 10 lakh, and in the assessment the income is increased to 17 lakh. So there was an addition of rupees 7 lakh. But out of this 7 lakh addition, I had an explanation which was accepted by the officer in respect of rupees 2 lakh. Okay. So this 2 lakh, on this 2 lakh, no penalty should be levied because this is not a part of underreported income. So my underreported income is only 5 lakh. So how will I compute a tax? I will compute a tax as on the income as determined in the intimation plus underreported plus 5. I will compute tax on 15 lakh. Then I will reduce minus tax on the income which was determined under section 143(1), 10 lakh. So this is the tax on underreported income. You are right. Understood? So whatever is the base, what is the starting point? It may be the income determined under section 143(1), or it may be the basic assumption limit if no return was filed, or it may be the income already assessed in case of reassessment. So you add underreported income to that starting point, compute tax on that income minus tax on the starting point income. The difference is the tax on the underreported income. Then apply 50% or 200% at the case may be. You're with me? In this case, see this, I did this case so that you have to understand the impact of rupees 2 lakh where the assessee could provide the satisfactory explanation. Let's take the simple case. Income return or income assessed 10 lakh. Income return or income determined the intimation 10 lakh. Income assessed 17 lakh. This 7 lakh is the underreported income. Now, how will I compute tax on 7 lakh? I compute tax on 17 lakh minus tax on 10 lakh. See the tax on 7 lakh. You're with me? 17 lakh is the income assessed. 10 lakh income determined in the intimation. Difference is the income or tax on underreported income. But this is fine. This way of doing things is fine. Only to the extent, only till the point, this 7 lakh actually underreported income. If there is any component, any part of 7 lakh which is not underreporting income, means thereby in respect of which either the assessee has an explanation or which has been computed on estimation basis, or this assuming out of this 7 lakh there is 2 lakh addition on account of TPO order. Then there is no penalty on 2 lakh. Then if you do 17 minus 10, the answer would be wrong. So therefore, always do what? Whatever the starting point. Starting point here is the income determined under section 143(1). We add underreported income. Underreported income is 5 lakh because On 2 lakh, there is no, it's not called underreported income because it's on account of order of TPO. So 7 minus 2, only 5 lakh. So I will compute tax on 5 lakh, 15 lakh, that's 10 plus 5, minus I will compute tax on 10 lakh. The difference, the resultant amount is the amount of tax on underreported income on which I will apply 50% or 200% of the case. 50% if it's a case of underreported income, 200% is if it's the case of misreported income, meaning thereby if it's falling under the any of the 6 clauses which we just studied. Misrepresentation, suppression of fact, or failure to record investment, bogus entries, recording false entry, not recording the sales, not recording entry in the books of account, or not disclosing the international transaction. Okay, this we have discussed. Now we are moving to section 273A. What's the section 273A says? 273A has two parts, 273A1 and 273A4. So it's actually an immunity or reduction waiver of a penalty with the power which has been given to the principal commissioner or commission. So they can waive or reduce the penalty levied on the assessee. Okay. So when the commissioner would lay, understand 273A, commissioner can on its own motion or on the application of assessee act. So what are the conditions to be satisfied to given a benefit of section 273A1? Now we are discussing 273A1. So there should be a full and true disclosure, and that too voluntary before the notice comes by the assessee. Assessee must have cooperated in the inquiry and he must have paid the entire tax and in the interest. Then to avoid genuine hardship, the commissioner or the principal commissioner may reduce or may waive the entire penalty under section 270A, whether it's a misreporting penalty or a underreporting penalty, not relevant. However, they will need the approval if the penalty is up to 5 lakh. So they don't need an approval, but if the penalty is more than 5 lakh, they need the approval of their bosses. But important thing, 273A1, where they can reduce or waive the penalty on their own motion also. It's only a once in lifetime opportunity. Okay. Now come 273A4. Here also, the principal commissioner or commissioner can reduce or waive the penalty, but only on the application of the assessee. And to do away, and they do to avoid the genuine hardship which may be caused to the assessee if the assessee has cooperated in any inquiries. The order in case of 273A4 has to be passed in 12 months from the end of the month in which application is received by the commissioner or principal commissioner. But here they need the approval of their bosses if the amount of penalty exceeds 1. Okay, so you understand the difference between 273A1 and 273A4. 273A1 is once in lifetime. They can do it their own motion and they need a approval of their bosses if the penalty amount exceeds 5 lakh. But in case of 273A4, it's not in once in lifetime. You can claim anytime. And in here, the approval of bosses is required if the penalty amount exceeds even the 1 lakh. The order passed under 273A is a final order. No appeal is allowed against the order of commissioner under 273A, whether 1 or 4. Of course, you can file the writ petition. Very simple examples. With this, we have completed one set of penalty for concealment of income for underreporting of income. Now we use our underreporting, not concealment. Okay. Now there are other penalties which are specific to a default or event. So 270A, 1A, if the assessee failed to get the maintain books of account as is required under section 44AA, the penalty is equal to 25,000 rupees. 271AA is a TP penalty. If you don't furnish or don't maintain the TP report, TP documentation, then 2% of the value of international transaction. 271AA2 rupees 5,000. 271AAD if there is a penalty, this is a penalty for false entry in the books of account or omission of any entry in the books of account. Either there is a false entry, meaning thereby you have claimed some expenditure only through a book of entry without any supporting evidence, but omission of a book, omission of an entry from the books of account. You have not recorded your sales properly. Okay. Then the penalty is equal to the amount of false entry. Sum equal to the amount of false entry. It's not a percentage of tax. It's actually equal to the amount of the transaction. So false entry can be false or falsified document. You have recorded an entry based on bogus invoices, false invoices. There is an invoice, but against that invoice, there was never a movement of goods. Without actual supply of goods, the bogus invoice, or the invoice is issued by a person who does not exist. Again, bogus. In all these cases, the penalty is equal to the amount of the transaction, amount of the expense or amount of the income you did not record. 27188. Important point. This penalty is not only on the assessee. Such penalty is levied on the person who makes such false entry, the assessee, and any other person who caused the person in any manner to make false entry. Okay, I'll not go much deep into this, but it says that any other person who make the assessee to do this entry. Who are these person? We know a little bit. Of course, we are not that these person, but something, some brothers and sisters of ours only are being targeted here. Okay. 271AA. So it's a penalty if the trust or institution registered under section 1023C or section 12A, if they give any benefit to specified person. Specified person means the author, founder, relative of such author, person who has made substantial contribution, all this. Then in such case, the penalty is equal to the 100% of the benefit provided. When subsequent, if there's subsequent default, then 200%. 271B, failure to get the books of account audited. Then if you fail to get your books of account audited, then the penalty is 0.5% of the turnover or rupees 1,50,000, whichever is less. Meaning thereby, the maximum penalty is 1,50,000. Okay. But remember one thing, if there was SSC, he was too naive, he was too innocent, he did not know that he was required to maintain books of account. So he neither maintain books of account nor get them audited. So whether he shall be penalized for rupees 25,000 for not maintaining books of account and penalty in section 271B of rupees 1,50,000? The answer is no. If books of account are not maintained, then the question of getting them audited does not arise. In such case, he will be subject to penalty of only rupees 25,000, not the tax audit penalty. Fail to furnish TP certificate, rupees 1 lakh, 271C. Failure to deduct tax. So if you fail to deduct tax, if you was required to deduct tax on any other payment and you fail to do that, then a sum equal to the amount of tax which was you ought to be deducted, which was required to be deducted, shall be amount of the penalty 271C. But this is one default, and 271C. Default is fail to deduct. Second is you fail to pay the tax under section 194B, R, S, or BE. So first is if you fail to deduct tax in any of the section of the TDS provisions, then there's a penalty of equal to the amount of tax you fail to deduct. But if you fail to pay the tax under these provisions, 194B, 194B says winning from lottery. 194R, it's benefit purchased in the course of business profession. 194S, it is virtual digital assets. 194BA, online game. If you remember, in all these four provisions, there is a concept of payment in kind. In such case, the law says if on a lottery, winning from lottery, if a person wins a lottery, then the giver, the person who was organizing a lottery, who is giving the lottery prize to the assessee, to the person, to the winner, he has to ensure that tax on this winning has been paid. Either he collects the tax amount in advance from the winner and deposit it, or he deposited from his own pocket. So in all these four cases, there is a payment in kind, and the payer has to ensure before releasing the payment, the amount, the gift, the winning, that the tax on such amount has already been deducted, has deposited with the government. So if you fail to pay the tax in these provisions, in these four provisions, then there's a penalty equivalent to the amount of tax you have failed to pay. Otherwise, if you fail to deduct a tax in any of the TDS provision, then there's a penalty equivalent to the amount of tax you fail to deduct. Assuming you deduct a tax under section 194C, you deduct it, no default. Okay. But you did not deposit it, did not pay. Question is, can penalty under section 271C be levied in this case? Answer is no, because there's a difference between fail to deduct and fail to pay. 271C is fail to deduct. The penalty for failure to pay is only qua four section, 94B, R, S, or BA. It's not qua 94C. So here, the assessee has correctly deducted the tax, though he had not paid it, then the 271C is not applicable. There may be some other consequences, which we will see later, but the specific question whether 271C can be levied or not, answer is no. Okay. 271C is similar for the TCS. Failure to collect, a sum equal to the amount which he has failed to collect. 271D is a penalty in respect to sustain SS. If you have accepted a loan in cash of amount 20,000 or more, then the amount of such loan or deposit is the amount of penalty. To sustain ST, if you have received any transaction of more than 2 lakh rupees in cash, then the amount of such transaction equivalent to the amount of such transaction is the penalty. To sustain SU, if we are required to provide the facility or to your payer, to your customer, so that they could pay the amount through internet banking, through banking channel, but you have not provided such facility, then a penalty equal to 5,000 per day. To T, if you repaid the amount in cash, then penalty equal to the amount of loan repaid. 271 FA. It is in respect of SFT, significant financial transaction. So if you was required to furnish a SFT statement and you have not furnished, there is 500 every day. And if you have not furnished even after the notice, then after the notice, it's the 1,000 rupees every day. You have furnished inaccurate information in the statement SFT, 50,000. And if you have not rectified it, then there's a continuing default. Then in this case, 50,000 plus 5,000 for every reportable account. If you're eligible investment fund and you was required to furnish a statement section 9A, if not furnished, then penalty is rupees 5 lakh. 271G. G means global, means the international taxation, means the transfer pricing. So if not furnished a report section 2D, then 2% of the international transaction. So if you could not remember the actual amount of the penalty in case of TP, then if you want to do a tukka, if you want to guess, do a guesswork, then guess it to be a 2% of the international transaction. In more than 50% of the case, in the case of TP, the penalty is 2% of the international transaction. Failure to furnish information document by Indian concern to 85A, 2% of the value of international transaction. And if there was a transferring the right of management control nation to Indian concern. So what happened is that, you remember the Vodafone case? There is an Indian company, above it, it's a, say, Mauritius company, above it, say, US company. The shares of US has been transferred. Then the Indian company was required to report this to the Indian Income Tax Authority that ultimate holding has been changed. If the Indian company has failed to do so, then it's a penalty of 2% of the transaction. 2% of the transaction amount is a huge amount. But only in case, because of pursuant to such transfer of shares, the control and management of Indian companies has also been transferred. That's purely a case of Vodafone. So they want this information, because in the absence of information, they cannot tax the US company on capital gain. So the penalty is 2%. But on account of this transfer of shares of the ultimate holding. If there is no transfer of control management of the Indian company, then the penalty is only is 5 lakh. You understand? In the first case, the impact, the loss, the risk of the tax authorities are huge, substantial. Therefore, the amount of penalty is also substantial. In the other case, the not so substantial. Why? Because in the first case, if the control management of Indian company has been transferred, then this transaction will be taxable in India. The transfer of shares of US company will be taxable in India, and there would be a capital gain. Yeah. So in the absence of Indian company reporting this transaction, the tax authority will never come to know, and there will be loss of tax revenue. Therefore, the penalty amount is also 2% of the value of transaction. But if the shares are transferred, which does not have impact the Indian company, then there is more likely than not the probability that this transaction will not be taxable in India, and therefore in this case the penalty is also limited to this 5 lakh. You have failed to submit the CBCR, country by country report in 286, then the penalty is up to a month, rupees 5,000 per day, beyond a month, rupees 15,000 per day, and if the default continues even after service of notice, then 50,000 per day. You furnish inaccurate information in the CBCR, and 5 lakh rupees. So do we remember to all these things? Not really. Yeah. You just focus on the important penalties. 270A, failure to get the books of account, maintain books of account, fail to get the books of account audited, then a TV penalty. Actually, this is only a collection of the penalties at one place. Otherwise, we study these penalties in the respective section wherever the respective provisions are covered. Okay, 271H, failure to furnish TDS TCS statement, 10,000 to 1 lakh. Serious TDS statement, TDS of TDS return. Any inaccuracy, 10,000 1 lakh. Failure to furnish Form 15 CACB, rupees 1 lakh. Inaccurate information, rupees 10,000 for each such information. 271K. So, if you remember, the scientific research organization and the ATG institution who have been granted registration section ATG. So they are required to issue Form 10B, to furnish Form 10BD and issue Form 10BE to all the person who has given them donation. So if they default in this, there's a penalty of 10,000 to 1. Then 272 is there's a penalty for minor defaults. The income authority serves a notice on you and you did not reply. Then there's a penalty of 10,000. Income tax notice of notice under section 131 and you did not reply. The penalty of 10,000. In the course of assessment, income tax authority asked for some information, you did not provide such information, a penalty of 10,000. If you could not furnish, remember we discussed in the last class, if there's a default in furnished return of income by the charitable organization or the institution exempt under section 10, then there's a penalty of 500 for every day during which the default continues. Failure to comply with the provision 133B, rupees, an amount up to rupees 1,000. In case of PAN, if there's a default, there was a penalty of rupees 10,000 for all such PAN defaults. Okay. So this was a complete list of penalties, and the important being the penalty of underreported income, which we discussed in detail. Now, if you remember, there are some undisclosed income sections, section 60A, 9A, 9C, 69, 69B, 69D. There are some six odd sections under which the income, whatever the income is assigned in this section, is taxable at the rate of 60% plus mandatory surcharge at the rate of 25% plus cess 4%. It gives 78%. Any income tax under section 68, 69A, 69, 69A, 69B, C or D, such income is taxable at the rate of 78%. So what this section says, section 68, the most important section, cash credit. It says that when any amount is found credited into your books of account, in your books of account there is some liability, any amount is credited, and and you could not provide the explanation of the nature and source of such amount. So there is a liability in your books of account which is showing the name of say Tarun Gupta, and you could not provide, there's a liability in amount payable in liability side, rupees 1 crore, and you could not provide the nature or source. Why you need to pay this 1 crore? Had you received a loan or what? Or if you received the loan, from where you received the loan? So if you could not provide the nature or source of this liability, this credit in your books of account, then the credit amount is treated as your unexplained income, taxable at the rate of 7%. Okay. Now, if such credit is in the nature of loan or borrowing, then not only you need to explain the source of this loan. Assuming in your balance sheet there is a loan from Mr. A, please 1 crore. So you explain the source. It was a loan taken from Mr. A with a banking channel. But this is not the end of the story. You need to explain the source of this 1 crore in the hands of Mr. A, from where the Mr. A gets rupees this 1 crore to advance you to rupees this 1 crore. So Mr. A has given you rupees 1 crore as a loan, so he must have got it from somewhere. And so you must explain the source of this 1 crore in the hands of Mr. A also. So we called it source of source. So you have to explain the source of source. You explain your source, which is Mr. A, but you have to explain the source of Mr. A as well, the source of source. If you could not explain the source of source to the satisfaction of the AO, then this rupees 1 crore shall be taxable in your hand under section 68 at the rate of 78%. Okay. If such credit is in the nature of share capital or premium, then if the shareholder is a resident, then again you need to explain the source of such amount in the hand of such resident. However, this provision is not applicable if the shareholder is a venture capital company or venture capital fund. Unexplained investment. If there are some investment and which are not recorded in your books of account, then you need to explain the nature and source of such investment. If you could not explain the nature or source, or the explanation provided by you is not satisfactory to the AO, then the amount of such investment taxable at the rate of 78%. Got it. So getting my point? You're with me? Section 69A, unexplained money. So if you found to be the owner of some money, bullion, jewelry, or the valuable article, anything, then you could not explain the nature and source of acquisition of such money, bullion, jewelry, then the amount of such money, bullion, jewelry which is found in your possession, or you found to be the owner of such money, bullion, jewelry, then the amount of such money, bullion, jewelry will be taxable in your hand under section 69A at the rate of 78%. But here the ownership, you must be the owner, not only the possessioner, not only the possession. If the in 69 or 69A, you did not record the investment or could not provide the source of the asset you owned. You know? But if you could partly recorded the investment or you could partly explain the source, then the other part for which you could not explain the nature and the source, the other part taxable under section 69C. B. The 69C is the unexplained expenditure. If you have incurred a lot of a big substantial amount of expenditure and could not explain the source of such expenditure, then the amount of such expenditure shall be deemed to be your unexplained income taxable under section 69C at the rate of 78%. And such expenditure is also not allowed as a deduction under any other head. Section 69D. If you have borrowed or repaid an amount on a hundi, then the amount of borrowed or repaid shall be taxable under as an unexplained income under 69D at the rate of 78%. Okay. So this unexplained income under section 68, 69, 69A, B, C, D is taxable at the rate of 78%. No basic assumption is provided, no expense, no loss is allowed against this income. And with in addition to 78%, there is a penalty at under section 271 AAC at the rate of 10%, merely 10%, because the income has already been taxed at a substantially higher rate, 78%. So the penalty is only limited to 10%. Also, this penalty is not leviable if the assessee has disclosed this income under section 139 and has paid a tax and interest before the end of previous year. 273B. This is a very small section, but it's a very important section from practical point of view. 273B says that no penalty can be levied if the assessee had a reasonable cause for such failure. So if there was not a malafide intention, was a mistake, or there was a reasonable cause for such default, if assessee could explain that reasonable cause, then the penalty is not levied. So this is the difference between a penalty and fee. Fee is automatic, penalty is not automatic. So if there's a fee, payment of fee, then the fee is leviable whether the assessee has a reasonable cause or not. If there's a default, then fee is leviable automatically. In case of penalty, it's not the case. If you can explain, if the assessee can explain that there was a reasonable cause for such failure, then the penalty is not levied. Penalty is levied with the approval JC. If the AO who is levying the penalty is ITO, then he need to take an approval of JC if the amount of penalty exceeds 10,000. If the penalty is levied by the assistant or deputy commissioner, then they need to take approval of penalty if the penalty amount is exceeding 20,000. So ITO can levy penalty only up to rupees 10,000. Beyond it, it has to take the approval of JC, Joint Commissioner. AC or DC can levy penalty only up to rupees 20,000. They have to take approval of JC if the amount exceeds 20,000. Okay, now these are different types of penalty which are levied in the case of assessee. Now we'll discuss the time limit of levying this penalty. So the time limit is very same and very easy, very simple. You're getting what we are discussing? Yes, sir. Yes, sir. Is it fast? Yes, sir. A little bit fast. But, sir, it is meant to be fast because this is revision. Revision has to be fast. You must have spent 2 or 3 classes on this chapter when you were understanding in detail. But now we need to do this division. Ultimately, we need to do the entire DT subject plus international taxation in 1.5 days before the exam. So, all these things we have to understand and revise fast. So, the time limit of levying a penalty. The penalty cannot be levied after the expiry of 6 months from the end of the quarter. Remember, from the end of the quarter. If there was an assessment and assessee did not appeal against the assessment order, then the 6 months from the end of the quarter has to be seen the end of the quarter when the proceeding, the assessment proceeding in which the penalty proceeding was initiated are completed. So, end of the quarter in which the proceedings in which the penalty proceedings were initiated are completed. Which proceedings are completed? The proceeding in where the penalty proceedings are initiated. So where the penalty proceedings are initiated generally? In the assessment proceedings. So during the course of assessment, AO makes an addition and at that time only he initiate the penalty proceedings. So the date when the penalty assessment proceedings are completed, you note that date and that quarter, then add 6 months to that. Assuming the assessment order came on, say today is 19 Feb 26. Then, and the penalty proceedings are initiated in the course of this assessment proceedings. Then this penalty can be levied up to, you will end this 31st March 26, add 6 months, it comes to 30th September 26. And the penalty initiated during this assessment proceedings can be levied, the penalty order can be passed up to 30th September 26. So in this case, the assessee has not filed an appeal against the assessment order. If we had filed an appeal against the assessment order under section 246 or 246A, or there is a revision under section 263 and 264, then I will see the date of the appeal order when such order is received by CIT, or the revision order when such order is passed by CIT. Assuming in this case, the assessee against this order of 19/2/26 assessment order, assessee filed an appeal before the CITA. And CITA passed the order, say, somewhere around 1st October 28. And it will take this much time. Now, till this time, the penalty can be kept on hold. And since I have filed an appeal, since the assessee have filed an appeal, in this case, the penalty order shall be passed. You will end this quarter, which is 31st October 28, and I will add 6 months. November, December, January, February, March, April. So 30th April 29. In this case, the AO will pass an order to 30th April 29 because the assessee had gone into appeal. Why we keep the penalty proceeding in abeyance in this case? Because assuming in the assessment, the CIT in the appeal proceeding, the CIT deleted all the additions, then the penalty would automatically have no legs to stand, would automatically be deleted. And therefore, we to avoid multiplicity of proceeding, what we request the tax officer to keep on hold the penalty proceeding till the CIT appeal order is passed. And if CIT appeal order is passed in favor of assessee, then there will not be any need to pass the penalty order. If it is passed against the assessee, then also you have a time at least 6 months. See, the CIT appeal order is passed on 1st October 28, and the last date 30th April 29. So once the assessment order is passed and the assessee intend to challenge the assessment order in appeal proceedings, so it files a letter with the tax officer requesting them to keep the penalty proceeding in abeyance. And tax officer generally do so because there is sufficient time. The penalty order is not getting time bar. It will get time bar on 30th September itself if the assessee did not file an appeal. Similarly, if I have filed an appeal to the ICAI against the order of CIT appeal, then also the 6 months from the end of the quarter shall be seen from the date of the ITAT order received by the CIT. In any other case, so if the penalty is not quasi-assessed income, is in respect of some other defaults which we discussed, then in all such cases, the penalty order shall be passed within 6 months from the end of the quarter in which the notice for imposition of penalty was first issued. So when the penalty was first initiated, you will end that quarter and you will add 6 months is the final date by which the order has to be passed by the AO penalty order. Okay. 275.2. It says that, see, this time limit is the maximum time limit, the upper time limit by which the AO has to pass the final order. But if I have filed an appeal to the CIT appeal, this 30th April 29 is the upper time limit by which the AO can pass order, but nobody stops an AO to pass an early order. He may say that, no, I will not wait for the CIT appeal, I will pass the order. Do whatever you want to do, but this is the maximum time I can pass. So he is within law to pass an order. So 275.2, it only says that if the order is passed without waiting the order of the appeal authority or revisional order under 263, 264, then this penalty order has to be revised subsequently in accordance with the order passed by CIT appeal or order in the ITAT or by the CIT under section 263, 264 as the case may be. While comparing this period of 6 months, the time taken given an opportunity under section 129 is to be excluded, and the time during which the proceedings were kept on stay is also to be excluded. So now we will start with the prosecution, the second part. So first was penalty. Now we'll do the prosecution. Prosecution means jail. Okay. So there are some severe defaults for which the law prescribes, the Income Tax Act prescribes prosecution. Not very much important from exam point of view, but we'll quickly study this. So section 275A provides prosecution in case of default of section contravention of order made under section 132(1) or 132(3). So 132(1), if you remember, is a deemed seizure. If any assets or any other valuable article cannot be seized because of WDV, if you remember, weight, dangerous nature, or the volume, then the AO may pass a deemed seizure order. If the assessee contravenes to that order, or if there was a prohibitory order, and in case of search only, if assessee contravenes that prohibitory order, then the assessee may be subject to rigorous imprisonment, RI, up to 2 years plus fine. In case of search, he may be imprisonment, rigorous imprisonment, the 2 years plus fine. If some person sells, removes, gives the assets to evade tax, to evade the tax recovery, then such person shall be liable for, may be liable for a prosecution government. Here, see, in the 271 prosecution, 3 months to 7 years. However, again, similar 3 years to 7 months. Attempt to evade tax, then if the amount of tax is up to 25 lakh, then 6 months. In any other case, 3 months to 2 years. It's less than 25 lakh. 276 double evaded exceed 25 lakh the assessment year, before the end of the assessment year, or before the lapse of a time provided for filing the updated return. Company, not being a company, if the amount payable, tax payable after adjusting all advanced tax, TDS, MAT, everything, is less than 10,000 or up to 10,000, then there is no prosecution. If you do not prosecute it for 3 months to 3 years. The section 42(1), you did not produce books of account of 42A, 3 months to 2 years. Ignore the offense for which prosecution has to be launched is committed by a company, then it is deemed that the offense is committed by a company and every other officer. And who other officers are involved? Every person who was in charge of the affairs, director, manager, secretary, every officer who is guilty of the offense. If that offense was from firm, then partner, AOP, then members, HM, then other members. Okay. This is important presumption as to a culpable mental state. So it's state mens rea. Willful offense. So prosecution can be initiated only when it is, so it was not a bona fide mistake, it was a mens rea, it was the guilty mind. The mind was actually intended to commit an offense and it was a deliberate offense. Okay. So what the section 278 E says that there was a presumption, the court would presume that mens rea was there. The defaulter, the offender, has a culpable mental state. Was the offense has been committed consciously, voluntarily, and the assessee, the offender, has to prove the otherwise. Only prosecution can only be initiated by the chief commissioner, principal chief commissioner, or the commissioner, principal commissioner. If any penalty has been waived or reduced in 273A, then in such case, the prosecution shall not be not much important, but this is something which has been a recent amendment. The CBDT has come up with the guidelines for compounding of offense. What do you mean by compounding of offense? Compounding offense means instead of sending the person to jail, the government may compound the offense. Compound the offense means government may ask the person to pay some. In lieu of that, he will not be required to go to the jail. So, if there is a provision, if the offense of such type which has a punishment of prosecution, that person has to go to jail, then the government may compound that offense and ask him to pay some amount. And in that case, in lieu of going to the jail. Okay, so this is called compounding of offense. Okay. So there are recent guidelines by 17 October 2024. So earlier, there were earlier guidelines. Now this have superseded the earlier guidelines. So what is compounding offense? Where defaulter pays certain sum to escape prosecution. Are all offenses compoundable? No. So generally, all offenses are not compoundable. But under the Income Tax Act, all offenses are compoundable. So in other laws, there may be some offenses which are not compoundable, for which the defaulter has to go to the jail. But under Income Tax Act, there is no offense which cannot be compounded. So whatever you do, you can escape jail, can escape prosecution by paying the compounding fee. So all offense in the Income Tax Act is compoundable. You just keep on listening this. It's not very much important from exam point of view, but you must have an idea. Who can compound an offense? Only the most senior officer, Chief Commissioner, Principal Chief Commissioner, or Director General, or Principal Director General. Not even the Commissioner. And you will see, even they cannot do much, and they have to take the approval of CBDT. So the applicant is required to file compounding for all the offences together for prosecution proceedings have been initiated. So it's not necessary that the applicant furnish the compounding application for all the offences. He may furnish an application for few of the offences which he feels like. So there is no limitation to the number of compounding application can be filed. You can file on year every year, wherever you feel that prosecution proceeding may be initiated or prosecution proceeding have been initiated. So compounding application can be filed even after the launch of prosecution proceeding. There is no time of filing the application. So when you file a compounding application, so there are 2 or 3 types of amount which you need to pay. First, you need to pay the compounding fee, which is 25,000 or 50,000. If there is a single application, then 25,000. If the compounding cumulative application means the application for different offences for different years, then 50,000. Then you have to pay the tax, interest, penalty in respect of the default which you have committed. Then you have to pay the compounding charges as determined by the authorities. This fees of 25,000 or 50,000 is the non-refundable fee, but adjustable fee. This amount shall be adjusted against the compounding charges finally decided. Non-refundable but adjustable. Okay, cross application adjustment is not permissible, meaning thereby you file say two applications, application 1, application 2. Here you pay 25 actually got compounded, and the compounding charge was rupees 20 lakh. So you need to pay 20 lakh minus 25. This is adjustable. Assuming here the application got rejected. So this fee cannot be adjusted against this application. This fee, if rejected, it has to be forfeited. It's not refundable. You have to pay all tax, interest, and other sums relating to the default. Only then you can come up with the compounding. You have to undertake that I will withdraw the appeal. You need not to withdraw the appeal immediately, because there may be a situation that this application may got rejected. Then what will happen to your appeal? So you just have to give a declaration that once it is accepted, I will undertake to withdraw the appeal. Okay, so I told you the offense can be compounded only with the approval of chairman CBDT. When you need a chair approval, you mean the chief commissioner or the director general. When they need the approval of the chairman of CBDT. In case of an offense for which the applicant is convicted with imprisonment for 2 years or more. If the punishment for such offense is 2 years or more. If the offense related to any other law. If offense related to anti-national or terrorist activity. In case of an applicant being a person other than the main accused, where it is proved that applicant facilitated tax evasion. Okay. See, in case of applicant being a person other than the main accused, where it is proved that the applicant facilitated tax evasion through mechanisms such as use of entities or laundering of money, generating of bogus invoices without actual business, or by providing accommodation entries. Or if the offense is under the declaratory offense under the black money or prohibition of benami property transaction. In all these cases, the approval of CBDT chairman has to be obtained. So, even if the applicant has been convicted, the offense can be compounded. So, once the compounding application is filed, so the Chief Commissioner or Deputy General, Director General, they ask for the report from the AO, the ATIT or DIT as the case may be. And if they want to reject the application, they have to pass the order of rejection with improvement from the end of the month in which application is received. Or if they want to pass the, if they want to go ahead with the application, then they provide an intimation of the amount payable by the assessee with improvement from the end of the month of receipt of the application. Then the applicant has a time to pay amount within 1 month from the end of the month in which such intimation is received by him. This amount can be extended to 6 months or 12 months and ultimately by the CBDT chairman up to 24 months. This period cannot be extended beyond 24 months. And if the amount is not paid by 24 months, then the application shall be rejected. The compounding order has to be passed in 1 month from the end of the month in which the amount is paid. You don't need to remember all these things. Just keep listening. It will be there in your subconscious mind. Okay. The CBDT says that what used to happen is that in case of NR or a foreign company, they don't go for the compounding, for the belief that they understand that the compounding may be treated as acceptance of a default, and in such case they have to report this acceptance of a fraud to their international organization wherever they are placed. So this will cause a lot of harm to them, and therefore they don't go for the compounding. But what the government wants more and more people to compound their offense. They don't want to just crowd their jails. They want money instead of that. And therefore, to encourage them to compound the offense, every compounding order shall state that this compounding order is intending to resolve the offense under section 279 and should not be constituted as admission of an offense. So this is to give a relief to such NR or a foreign company that it's not an admission of an offense by you. It's only a settlement between you and the Indian government. Okay. So, but if you are multiple offender, then the compounding charges will be more. It says that if a person applied for compounding of offense, the type of which was applied for earlier, similar offense, if you're again compounding, then the compounding charge for subsequent offenses shall be 1.2 times, 1.4 times, 1.6 times, and so on, of the compounding charge of second, third, fourth, etc. time of such an offense. So if it's your first application, then you need to pay compounding charges. If your second application, then you need to pay 1.2 times of the compounding charges. If third, 1.4 times. If fourth, 1.6 times. Fifth, 1.8 times. Sixth, twice the compounding charges. Seventh, 2.2 times, and so on. So the more the application of same section, the higher the compounding charges. Okay. And they talk about the application. So it's not necessary that the earlier application actually was admitted and the order was passed. If the earlier application was rejected, still the second application is deemed as second application, and the the applicant shall be liable to pay 1.2 times of the compounding charges. Okay, you have me? And if you apply for the compounding after 1 year from the initiation of the prosecution, then the compound you have to pay 1.5, 50% more, 1.5 times of the compounding charge. So assuming it's a third application, so if the compounding charge was say rupees 10 lakh, then you have to pay 10 lakh into 1.4, which comes to 14 lakh. And if this application is made after the 1 year of the initiation of prosecution, then 50% more, it comes to 27 lakh. You have to pay 27 lakh as compounding charges. Okay. And it says if the compounding application was made in accordance with the earlier guidelines, so all such applications shall be deemed as one application. Where the compounding application has been filed in accordance with prior guidelines and are either pending or were rejected or have been compounded, all such applications filed prior to issuance of these guidelines shall together be constituted as first compounding application. If application is made beyond 12 months from the end of the month in which prosecution complaint is filed, the compounding charges shall be increased by 50%. Okay. So there are two small examples. You can do it as a part of your small homework. It's very simple. So we are done with this compounding guidelines. Yes. Now we are left with the last section, our penalty and prosecution provision, section 270AA. What section 270AA says? It's again an immunity. Not a lifetime. You can await year on year, no worries. But you need to satisfy some condition. It's an immunity given by the AO itself, not the CIT. So what it says that if there's an addition in your case in the assessment proceedings, then if you don't file an appeal against the addition, so you admit the addition, you pay the tax and interest within the time limit provided in the notice of demand. So you pay tax and interest within the time limit, and within 1 month from the date of the order, you file a form requesting the AO to give immunity against the penalty and prosecution. And lastly, the penalty initiated is not on account of misreporting. It was on account of underreporting. We are not coming under that 6th clause. The penalty is initiated in the assessment order itself, which says you have not filed an appeal against the assessment order. You have paid the tax and interest, whatever was asked in the notice of demand within the time provided in the notice of demand. You have furnished a form with the AO, section 270AA, within 1 month from the assessment order. And the penalty initiated in the assessment order is not on account of misreporting. So penalty initiated is 50% of the tax. Okay. So you have paid the tax and interest within a period specified in the notice of demand. You have not furnished an appeal against the assessment order. You have made an application within 1 month from the end of the month in which the assessment order was passed. And there is no immunity for misreporting penalty. The only penalty proceeding have not been initiated on account of this 6. Remember, misrepresentation or suppression of fact, failure to record investment, recording an expenditure without an evidence, recording false entry, or failure to record receipt, or failure to record international transaction. If the penalty is not on account of any of these, then, and you have paid a tax and interest, you have not appealed against the assessment order, you have furnished the form within 1 month from the end of the month when your assessment order was passed, then the AO can give you immunity from the penalty and prosecution both, from penalty and prosecution. But AO has to pass the order within 3 months from the end of the month in which such application is received by it. It cannot pass an adverse order unless ordi ortem partem, unless opportunity has been given to the assessee. We call it ordi ortem partem. It's a Latin word for the phrase providing opportunity of being heard. Again, this order is the final order. You cannot file an appeal. But you remember, if the your application SN 270AA is rejected, then the time when you file the application, period starting from the date you file the application up to the date you receive the rejection order is excluded in the time limit for filing appeal to the CITA against the assessment order. Because you understand, assuming you received an order on 10th Jan 26, then you can make an application under section 270AA by 28 Feb 26. You end this month, 1 month from that month. Okay. And the AO can pass an order within 3 months, means March, April, May. 31st May 26. Now, if on 31st May he pass an order and reject your application, then you was required to furnish an appeal against this order by 9th Feb 26. This has already lapsed. So what the law says, in this case, the period starting from the date you made the application up to the date the order shall be excluded by computing a 30 days period. The exclusion of period when application of immunity is pending before AO from the time you are filing appeal before CITA. What period excluded? The date on which application was made, the date on which order rejecting the application is received by the assessee, served on the assessee as the case may be. So this completes our penalty and prosecution. We'll take a 5-minute break. It's 1924, 724. We'll meet again on 7:30 and we'll start with the Black Money Act. Okay. We'll take a small break of 5 minutes. Thank you. came in 2014, and this Black Money Act came with effect from financial year 15-16. So why it came? It came to penalize the persons, the Indians, who have their income outside India, which they don't offer tax in India, or who have their assets built up outside India. So what it says, if I give you a brief, it's applicable on undisclosed foreign income and undisclosed foreign assets. So two things: the undisclosed foreign income and the undisclosed foreign assets. So if some person has a income outside India which has not reported in the return of income in Indian return of income, then such income is called undisclosed foreign income. If any person has any asset outside India and he is not able to undisclosed foreign income, means the income you have earned outside India, assessee has earned outside India and has not reported in his Indian return of income or has not furnished Indian return of income. And second is the undisclosed foreign assets, means the assets outside India. Asset includes the interest in the financial interest in any entity, means you hold the shares of some foreign company or debentures in the foreign company, or interest, or you are a partner in some overseas partnership firms or LLPs, and also includes overseas bank account. So bank account, the Swiss bank account, bank account in the US, America, US, UK, Singapore. What they will do in this Black Money Act? This is actually the Black Money Undisclosed Foreign Income and Assets and Imposition of Tax Act. Okay. So what they will do? They will tax the undisclosed foreign income and undisclosed foreign asset at the rate of 30%. That's not a big thing, but they will levy a penalty equal to 3 times of the tax amount. So if they found you have an asset of rupees 1 crore in Dubai, then they will tax it at the rate of 30%, means 30 lakh, plus 3 times the tax amount is the penalty. Plus 90 lakh is the penalty. It comes to 1 crore 20 lakh. 220 lakh is the amount which you need to pay to the Indian government against your asset of rupees 1 crore. So big issue for the defaulters. Okay. So that's why it's a very severe act, very difficult act. Okay. Now, one more thing important for you is that the income, the undisclosed foreign income is taxed in the year to which it relates. If it relates to financial 1780, it will tax in the financial 1780. But the undisclosed foreign assets shall be taxed in the year in which it comes to the notice of the tax officer. So, assuming there is undisclosed income in financial year, there are 13, 14, 14, 15, 15, 16, 16, 17, and so on. So, all this income will be taxed in the respective year. Fourth, in these 2 years, there will be no tax because the Black Money Act came from previous year 15, 16. Okay. But assuming there is a person, Mr. A, who bought a bungalow in Thailand, 4 rupees, or you may say $4, 10,000 in the year 2009. Okay. Now, in the year 25, 26, the tax officer came to know about this bungalow in the Thailand of Mr. A. Now, this bungalow of Mr. A in Thailand shall be taxable in the year 25, 26 only if he is not able to provide the source of such investment. Even though the same was bought in 2009, even before the application of the Black Money Act. Still, it will be taxed in the year in which it comes to the notice of the tax officer. If it comes to notice of the tax officer in year 25-26, it will be taxed in the year 25-26. Okay. So let's see what Black Money Act says. It says every assessee will be liable to pay tax at a 30% in respect of undisclosed foreign income and undisclosed foreign assets. There are two things: undisclosed foreign income and undisclosed foreign assets. However, undisclosed asset located outside India shall be charged to tax on its value in the previous year in which such asset comes to the notice of the AO. Understand? The income is taxable in the year to which it relates, but the asset is taxable in the year in which comes to the notice of the AO. Undisclosed foreign income and asset means the undisclosed income of an assessee from a source located outside India. An undisclosed asset means the asset of which either the assessee is actual owner or he's a beneficial owner. You know the beneficial owner? Beneficial owner means a person who has actually paid the consideration directly or indirectly. And he has no explanation about the source of the asset outside India, whether as a registered owner or a beneficial owner. He owns an asset outside India. And you could not provide the satisfactory explanation about the source, how you got that asset. Now, who is an assessee? Can an NR be assessee? NR, of course, would have an asset outside India. How can you tax him? You don't have an access against the NR. But assessee can only be R. So, if an Indian resident, because only the resident has a global income taxable in India. So, if you are an ROR and you have any undisclosed foreign income or foreign asset, then you are subject to Black Money Act. Okay, but not only this. There may be a situation that you now are NR, but at the time when the income accrues, or at the time when you actually acquired the asset, you were R. So, if you were R at that time, still, and now you are NR in India, still you will be subject to Black Money Act. So, who is the assessee? Assessee is either a R in the current year, in the relevant year, in the subject year, or NR in the subject year, but he was an R. He was an R in the year to which the income relates, or in the year in which the asset was actually occupied or actually acquired. So assessee means a person who is resident in India, or who being a non-resident or RNOR, but who was resident either in the previous year to which the income relates, or in the previous year in which the undisclosed asset located outside India was acquired. And here the word acquired means the actual acquisition. It doesn't mean the deemed acquisition where under this act, because as I told you, this act deemed that the asset is acquired in the year when it comes to the notice of the AO. Okay. So this deeming fiction is not applicable in the definition of assessee. Here, acquisition means the actual acquisition. So if here the asset was acquired in 2009, when it comes to the notice in the year 25-26, so assuming that this Mr. A is non-resident in the year 25-26, still he can be subject to Black Money Act if he was resident in the year 2009. Again, same thing. Undisclosed asset shall be charged to tax of its value in the previous year in which the asset comes to the notice of the AO. Okay, now the important thing, how we compute the fair market value of the asset, the value of the asset on which undisclosed foreign asset on which tax is to be levied. So I told you there's a bungalow which he was purchased for $10,000. So now he has to pay a tax in the year 25-26. So on what value he will pay the tax? The law is simple. Law says that you will pay the tax on the cost for which you acquired it on FMV as on now, as on first day of the previous year. Which previous year? when it is you are being taxed. In this case, 25, 26. So first apply 26. So the cost for which you actually acquired it or FMV as on first day of the previous year, whichever is higher. So they will tax you on the higher amount, not on the cost amount. So again, a penalized provision. How will you compute the FMV? You compute it through the value registered with that authority, with the government, or in case of listed equity share, you can compute the average of the lower or higher value of the price it was traded in the stock exchange of the foreign country. So if the asset is, if the asset is bullion, jewelry, or precious stone, the value of the asset shall be higher of cost actually acquired or the open market value as on the valuation date. What is the valuation date? Is the first April of the previous year in which this amount is being taxed. And here, first April 26. So higher of cost or open market value means the fair market value. In case of archaeological collection, drawing, painting, sculpture, any work of art, similar, higher of the cost or the price which this would fetch in the open market value as on the valuation date. If the quoted share, quoted means the listed share, similar, higher of the cost or the fair market as on the valuation date. But how will you compute the fair value? Fair market value is the average of the lowest and highest price of such share on the valuation date. If there was no trading on the valuation date, then higher average of the higher lower price on the date immediately preceding the valuation date when there was a trading. Let's wait for the unquoted equity shares. We'll do the rest one. Unquoted shares other than the equity shares, higher of the cost or the price in the open market value. That price can be determined based on the report of a valuer. Immovable property, higher of the cost or the price in the open market value as on the valuation date. Any other asset, higher of the cost or and the value in the open market value as on the valuation date. So for jewelry, artwork, listed equity shares, immovable property, or any other asset. For all this, the value of this asset, of this foreign asset shall be higher of cost of their FMV as on 1st April of the previous year. You with me? Yes, sir, we are with you. You're getting my point now? Yes, sir, we are getting it. Good. But in case of immovable property, in case of any other asset, in case of jewelry, in case of artwork, you can get this FMV through the value registered with the government of such foreign country. Or in case of listed equity share, assuming you have equity shares of Facebook or what we call Meta, Facebook, or Netflix, Microsoft, Apple, Amazon, this blue chip company of US. Then in such case, you have a foreign asset. This is an asset. This is a financial interest in an entity. Entity being the foreign company. So you have a foreign asset. And if you could not explain the source of such investment, then it will be treated as undisclosed foreign asset. It will be taxable in the Black Money Act in your hands. And the value shall be the cost for which you acquire this asset or the fair market value as on 1st April 2026. And how you compare fair market value? You will average the lower and higher price on 1st April 26 in the stock exchange, US stock exchange. I mean NASDAQ. So you will compute this value of whichever is higher is the amount, which is the value on which tax shall be levied. Okay. So now we are left with 3 assets. One is unquoted shares and securities. How will you compute the value of unquoted shares? Very simple. A plus B minus F. A means the book value of all assets except immovable property, bullion, jewelry, and artwork. B means market value of jewelry, bullion, artwork minus liability. This will give you the net worth of the company. You divide the paid up capital and multiply with the capital equivalent to the shares held by you. So you proportionate this net worth and determine the value of the shares which you hold. So the value on the valuation date of such share determined the following manner: A plus B minus L into PV divided PE. So A is book value of all assets other than bullion, jewelry, precious stone, artistic work, shares and securities. Of course, you will reduce the TDS advanced as. B is the fair market value of the asset excluded above. L is the book value of the liability. But in the liability, we will not consider the equity share, paid up equity share, the amount of dividend, the reserve and surplus, except the accumulated depreciation. Accumulated depreciation is considered as a liability. Amount of provision for income tax, other than the tax actually liable to pay. Amount of provision for uncertain liabilities or amount of contingent liabilities. These are not part of your liability, and we also, in accounting terminology, understand that these are not the liabilities. PE is the total amount of paid up capital. PE is the paid up capital or paid up value of such equity share. Such means the equity share held by you, held by the assessee for which we are computing the value. Then the bank account. If you have a bank account, the assessee has a bank account outside India, which is undisclosed, then what is the value? So it says that you just aggregate all the deposits. So whatever amount is deposited since the date it was opened, you aggregate all deposits to be liable. You just forgot about the withdrawal, just aggregate all deposits, and the aggregate amount is the value for the bank. But one thing, if any amount is withdrawn and deposited again, then such deposit is not considered. So what it says that, assuming you deposit $10,000, you have to take the deposit from the day the bank was open, bank account was open. You have to year on year just add on the deposits. $5,000, $20,000, $30,000. Though you may have withdrawn $1,000, $5,000 for whatever purposes, so you have to just ignore this. But assuming here you withdrawn $10,000 and you deposit this $10,000 as a part of $30,000. Say assuming here only $10,000 is there. Then while aggregating the deposit, you will ignore this. Okay, here the value shall be 35,000. Okay. So what does it say? It says the sum of all deposit made in account with the bank since the date of opening of the account. However, where any deposit made from the proceeds of any withdrawal from the account, such deposit shall not be taken into consideration. Understand? There may be another example. Assuming you have an account in Swiss Bank and Bank of America. Both are undisclosed. So you aggregate the deposits. The deposit aggregates, say 100,000. Here it's 200,000. But out of this 200,000, there is an amount of 50,000 which was withdrawn from Swiss account and deposited in Bank of America. So while aggregating the deposit in Bank of America, you will not consider this 50,000. So the value shall be 150,000. So it's not necessary that the amount withdrawn from the account has to be deposited in the same account. If it's withdrawn from one account and deposited into another account, then also while computing the value of the other account where it has been deposited, you will ignore such deposit. You understand? Yes, sir, we understand. Now, lastly, if the assessee has an interest in a partnership from outside India, how will you value that interest? Very simple. You just compute the value of the firm as A plus B minus L. Whatever amount you got is the net worth of the firm. to divide this net worth into two parts. Say, assuming you got 100 rupees, you divide into two parts. One part is the aggregate of the capital contribution by all the partners. Assuming there were three partners, each contributed 10, 10, 10. So 30. And the other part is the remaining part, 70. So he has contributed 10 rupees. Everybody has contributed 10 rupees. So this 70 shall be proportionate in the dissolution ratio. Means the ratio in which the asset is to be distributed to the partner at the time of dissolution. If there is no dissolution ratio given, then this 70 shall be a portion in the profit sharing ratio. Assuming they have the profit sharing ratio of equal. So 70 divided by 3. This shall be the interest of the assessee in the partnership firm. Simple. Okay. So what we discussed? We discussed that this Black Money Act is applicable on undisclosed foreign income and undisclosed foreign asset. Undisclosed foreign income is taxed in the year to which it relates. Undisclosed foreign asset is taxed in the year when it comes to the knowledge of the AO. Who is the assessor? Is a person who is resident in the currently is a resident, or who is NR, but he was a resident in the year to which the income relates, or in the year when the asset was actually acquired. Okay. Tax is at the rate of 30% plus a penalty of 3 times. Okay. The asset is valued on the basis of higher of the cost or its fair market value as on first April of the previous year. Okay. But there is in case of listed equity share, the fair market value is computed as an average of lower and highest price in the exchange. Okay, as on the first day of the previous year, as on the valuation date. If there was no trading on the valuation date, then you would take the average of the lower higher to any preceding date when there was a trading. Okay. Now, in book value of all assets except money, except jewelry, bullion, shares, security, or more property. B is the fair market value of these assets minus L is the liability. In liability, will not include the paid up, the capital, the reserve and surplus, except the accumulated depreciation, the contingent liability, the provision for uncertain liabilities. Okay. Now, how we look if there is a bank account, undisclosed bank account, foreign bank account, the value of such bank account shall be the aggregate of all deposits made in such bank account since the date the account was opened. But if any amount is withdrawn and then deposited, then such deposit shall be ignored. Lastly, if the assessee has an interest in a foreign partnership firm, then such interest shall be valued as you compute the net worth of the firm by applying A plus B minus L. Such net worth shall be divided into two parts. One is the capital contribution, and the remaining shall be a portion between the partner in the ratio of dissolution, in the ratio dissolution ratio, or in the absent dissolution ratio in PSR, profit sharing ratio. Okay. Now it says that, so you are with me? It took us only 5 minutes. And FMV of asset transferred before valuation sale. So assuming there was a house in Thailand, and which was purchased in 2009, assuming it was sold in 2017 and 18. And now in 2025-26, this fact has come to the knowledge of the tax officer that the assessee had purchased a bungalow in 2009 in Thailand, which is sold in 2017 and 18. Can this house be taxed? Yes, this house can be taxed. And the value of this house shall be the cost for which it was acquired and the sale price for which it is sold, whichever is higher. And if thus it is been sold for inadequate consideration or gifted, then the fair market value on the date of transfer. So if it's sold for at arm's length price, the value shall be for or the sale price, whichever is higher. But if sale price is inadequate, then the cost or FMV on the date of transfer, whichever is higher, shall be considered as the value of the asset already sold, transfer. So transfer before valuation date means the value shall be the higher of the cost and the sale price. Where such asset was transferred without consideration for inadequate consideration before the valuation date, FMV of the asset shall be that assuming SSC had a bank account in Dubai and it deposited multiple times, and the aggregate of deposit is say $100,000. Right? Yeah. Okay. But it has also withdrawn from this bank account, say $50,000, because we ignore the withdrawals. And from this $50,000, we had purchased a flat in Dubai for $50,000. Now, in 2025-26, the value of the house which he purchased, this value of this house in Dubai, is say $75,000. Okay. Now in 25-26, his undisclosed foreign assets shall be the aggregate of deposit 1 lakh, and this house, the cost of fair market value whichever is higher, 75,000. So it will be taxed on 1,75,000. Answer is no. If you see, there is something illogical. There is something double counting. This 50,000 is included in this also, in bank balance also. Yes. Yeah. And you are again including it as a separate asset. So what the law says, if an asset was purchased from the proceeds of some other asset, then this asset shall not be considered. See what it says? In fair market value, in a case where new asset is acquired out of consideration received on account of transfer of old asset or withdrawal from a bank account. In such case, the fair market value of old asset or the bank account, as the case may be, determined as above, shall be reduced by the amount of consideration invested in new asset. So there was an old asset. I sold it and used the proceed for new asset. Now, when you are taxing me, you cannot tax the both. You will ignore old asset and you only tax the new asset. In this case, this 50,000 was used for buying the house. So my bank account balance shall be 1 lakh. 100,000 minus 50,000 comes to 50,000 plus the new assets 75,000. So I will be taxed on 125,000. Okay. There's a small example. If you want, time allows us, we can do it. House A located in a country outside India was bought in 1995 for 15 lakh. Okay, there's a house which was bought in a country outside India for 15 lakh. It was sold in year 2000 for 22 lakh. This amount was deposited in a bank account in that country. In the year 2001, another house B was purchased for 35 lakh. The investment in house B was made through withdrawal from the bank account in the foreign country. House B has not been transferred before the valuation date. I still hold it. And its value as on the valuation date is 48 lakh. I purchased it for 35 lakh. Now it is for 48 lakh. Assuming the value of the foreign bank account as computed under Rule 3 is 60 lakh, the fair market value of the asset would be computed as under. So it says that there was a house A which has already been sold. The second asset is a bank account, and third asset is the house B. But if you see, house A, the value of the house A will be the cost or the sale price, which I was here, 22 lakh. But here the 22 lakh has already been deposited into a bank account, which I am considering. So now I will not consider this 22 lakh. The value of the bank account is given as 60 lakh. It means the 60 lakh means the all deposit made in this bank account is the 60 lakh, aggregated to 60 lakh. But if you see, out of this all deposit, I had withdrawn also how much? 35 lakh, for which I have purchased house B. So this 60 lakh shall be reduced by 35 lakh, and the value of the bank shall only be 60 minus 35, 25 lakh. And house B, I will include, which is 35, purchase for 35 lakh. Now the price is 48 lakh, whichever is higher, 48. So these two are my total value on which I will be subject to black money. So house A nil, bank 25 lakh, and house be 48 lakh. Okay. Now, all these assets would be in foreign currency. How will I convert into Indian currency? Very simple. We use the exchange rate. If the currency is permitted currency as per RBI, you will use the exchange rate as on first day of the previous year, the valuation date. If it's not permitted currency, then you will first convert it into USD and then convert it into INR. So a small act, but a very much interesting act. So valuation date means the first day of the previous year. Undisclosed income means the income which has not been disclosed in the return or no return has been furnished. Undisclosed asset means the asset not disclosed. Purchase, you cannot explain the source. But it says if some income which is undisclosed for the purpose of, or there was some asset the source of which cannot be explained, but such amount has already been taxed under the Income Tax Act, then such amount will not again be taxed under the Black Money Act. And similarly, if some amount has been taxed under the Black Money Act, it will not again be taxed under the Income Tax Act. So mutual exclusivity is maintained. Against the undisclosed foreign income or asset, no expenditure set-off is allowed. And okay, so this is good. It says, assuming there is some undisclosed asset, it's not fully undisclosed. It's only partly undisclosed. So assuming there is you found a bank account, or you found a jewelry outside India, which was purchased for $100,000. Out of this $100,000, $40,000 is explained was a money on which tax was paid in India and it was remitted outside India, and $60,000 is undisclosed. Okay. This 40,000 is explained and 6,000 is explained in undisclosed. Now the value of the jewelry is say $150,000. So would this $150,000 will be taxed and as it would be considered black money? Answer is no. Out of $150,000, $40,000 is explained, so only $110,000 shall be taxed on the black money, the undisclosed foreign asset. But had it been a case of immovable property, $1 lakh outside India, out of which $40,000 were explained, but $60,000 were unexplained. Now the value of the immovable property is $150,000. In this case, of course, the higher is the $150,000, but the undisclosed asset shall be not 1,10,000. You will proportionate it. So when you purchase the asset, 40% was explained, only 60% was unexplained. So now out of the value of 150,000, 60% shall be treated as unexplained. So 60% of 1,50,000 is 90,000. So you will tax only on $90,000. But this way, the proportionate is this way of computing the undisclosed income, undisclosed asset, or computing the value of undisclosed asset is only applicable in case of immovable property. If there is any other asset, then whatever the value you determine as on the valuation date, you just reduce the amount which was paid in white. Okay. So a small example, it will clear the concept. A house property located in a country outside India. So it's a house property, you will do the proportionate. Okay. Was acquired by Mr. A and SSC in previous year 12-13 for rupees 60 lakh. Out of the investment of 60 lakh, 35 lakh was assessed to tax in total income of previous year 12-13. So it was in white in earlier years. Such undisclosed asset come to the notice of AO in 25-26. If the value of house property is 120 lakh, so the value shall be 60 lakh, 120, whichever is higher, 120. But out of 60, the explained part was 35. So out of 120, the explained part would be 70. So the undisclosed asset shall only be 50 lakh. Okay. penalties. So what we discussed, now we are actually see the provision. So section 41 says that the tax penalty shall be levied equal to 3 times the tax so computed on the undisclosed income and undisclosed foreign asset. Okay. So more and more. Also, not only this, if you have not reported the foreign asset in your Indian return of income, then there's a penalty of 10 lakh rupees per year. If you have furnished the return of income, not furnished, then also. So 10 lakh. But this 10 lakh rupees penalty shall not be levied if the amount of foreign asset is up to rupees 20 lakh, except in case of immovable property. So if a immovable property outside India for value less than 20 lakh, and you have not reported that immovable property in the Indian income tax return, then there will be a penalty of rupees 10 lakh per year. But if assuming you have any other asset other than the immovable property, assuming you have a shares of Facebook, Netflix, etc., and the value is less than 20 lakh, then there is no penalty. No penalty in section 42-43 means no penalty for non-reporting. But the tax on undisclosed foreign asset shall be levied. 3 times penalty shall be levied. If you do not pay the tax, if you default payment tax, the equivalent amount of tax shall be the penalty. If there is any other default, you do not produce the books of account, you reject to sign, you default, you fail to sign any statement, you fail to answer any question, then there is a penalty of 50,000 up to 2 lakh for each such default. So prior approval of JC or JD, Joint Commissioner or Joint Director shall be obtained if penalty is levied by the rank of AO for an amount exceeding 1 lakh or for an amount exceeding 5 lakh if the penalty is levied by the AC or the DC as the case may be. So approved prior approval JC, if the AO, the one who is levying the penalty is ITO, then he will need the approval of the penalty amount exceeds 1 lakh. If the officer who is levying the penalty is AC or DC, then he will require the approval of JC for the amount of penalties exceeding 5 lakh. So he can levy the penalty up to 5 lakh without the approval, but for penalty more than 5 lakh, he will require the approval of JC. So similar to income tax, there are also prosecution. So these prosecution under the black money is in addition to and not in derogation. Means it is in addition to any other prosecution proceeding under any other law. And it's not in derogation. It will not derogate them. It is in addition to that. So prosecution proceeding under the any other law shall continue. Under the Black Money Act also shall apply. If there is a failure to furnish the return, then the prosecution 6 months to 7 years. But no prosecution if the return is furnished before the expiry of assessment year, similar to the income tax. If you could not furnish the information about the asset located outside India, the penalty is the prosecution is 6 months to 7 years fine. If there is a willful attempt to evade tax by any person being a resident, ROR, then the prosecution 3 months to 10 years. And other than ROR, then 3 months to 3 years. Similar to income tax, there is a presumption to the corrupt mental state. Similar to income tax, the prosecution can be initiated only by the most senior officers, Chief Commissioner or the Deputy General, or Principal Chief Commissioner or the Principal Deputy Director General. If the offense is committed by the company, then who is prosecuted? Both the company and the officers who are in default. However, if some director of the company proves that he was not involved, then he will not be prosecuted. But if you are an officer of the company, who you shall also be deemed to be guilty of offense if the offense was committed with your consent or connivance. Connivance means you knew about the offense, but you did not object it. Company includes a firm, AOP, BOI, or FPO for this purpose. If there is a second and subsequent offense, then there is a regress imprisonment for 2 to 3 for a term of 3 to 10 years, with the fine ranging to 5 lakh to 1 crore. Not very much important, the prosecution. So this completes our first chapter the most important chapter. You know, there's some small cases. Let's study. So it says that the assessor did not deduct a tax based on the professional advice. So he did not deduct tax based on professional advice. Can he be subject to penalty section 271C for not deducting the tax? So what the Karnataka High Court said that there will not be any advantage to the deductor for not deducting a tax. He acted in a bona fide manner. He took the advice of a reputed chartered accountant firm, and based on that advice, he did not deduct tax. So there was no malafide intention. There is a reasonable ground of the default of his act, and therefore penalty should not be levied. This was held in the case of Jindal Tractable Power Company Limited. If the assessor acted upon the professional advice and therefore had not deducted tax, then there will not be any liability penalty. Can penalty under Section 271C be levied for non-payment or belated remittance of TDS? So we discussed this. 271C is for non-deduction. Non-payment is relevant only for the fourth section referred therein, or all other sections penalty is relevant only for the non-deduction. So non-payment, there is a separate provision. There is a prosecution and other things, but penalty under Section 271C cannot be levied for non-payment. This similar thing was held by the Supreme Court in the case of US Technologies. Now, the Supreme Court, okay. This is the important, this is very interesting. Can prosecution proceeding under Section 276B be launched for delay in deposit of tax, where the period of delay and the amount of TDS were not substantial, and the amount of TDS was subsequently deposited with some delay along with interest? So it may happen that there 1 day, 5 day, 1 month, 2 month delay in deposit of tax TDS, and such TDS is wanted deposit along with interest in the setup in normal running of business. It generally happens. So department cannot issue prosecution notices for even small delays involving small amount of TDS. So this Supreme Court said that prosecution under Section 276B shall not normally be proposed when the amount involved or the period of default was not substantial and the amount in default has been deposited in the meantime along with the interest to the credit of central government. Would prosecution proceeding under Section 276C be attracted where the failure to furnish return in time was not willful? So not only this, no prosecution proceeding can be attracted unless the offense is willful. So lastly, in the case of D.K. Shiva Kumar, what happened that a search happened in his premises and some undisclosed loan was found. So a prosecution proceeding was initiated and alleging that the loan was not disclosed with a view to evade tax. So what the court said, that Karnataka court, there is no presumption under the law that every unaccounted transaction would lead to imposition of tax. So the court said that department has to actually give a direct link, direct nexus of the unaccounted transaction with the evasion of tax. If the loan has not been shown, it does not mean that income has been evaded. Therefore, prosecution proceedings should not be initiated. Okay. Now let's move to the next chapter. This is very small chapter, very much interesting chapter, and 4 to 5 mark question are being consistently being asked on this chapter. But before this chapter, this is the chapter of by the name Tax Audit and Ethical Compliances. What does it say? It gives. We will discuss the provision section 44AB, the tax audit provision, the detailed form, and the most important part, the ethical compliances. See, I'll take a minute of you. This ethical compliance are actually the founding stone of any profession. whether it's a medical profession, it's an advocacy profession, or it's a chartered accountancy profession, the individual who are practicing this profession has to follow the ethical compliances. Only because of this, because of the ethical compliances, the profession can survive. If the individual practicing such profession get into unethical practices at a larger scale, at a mass scale, then it is very difficult to survive the profession. So once you become a chartered accountant, you will be the brand of this issue. So it's very important that you act in an ethical manner. This ethical manner is more important, is more discussed in the audit chapter, but a very small part is discussed in income tax as well, because here also I do a certification thing. I certify the audit of tax audit, and also I issue a lot of certificate under the income tax. So let's see what all certificate other than tax audit I do. Under section 12A, I give a tax audit report in form 10BB or 10B. Any SSC claiming a deduction under section 80IA to 80IE will require a form of 10 CCB from a chartered accountant. SSC claiming deduction section 80 JJAA, he is required to furnish a form 10DA certificate from the chartered accountant. The deduction has been rightly computed. If you are paying tax under section 115JB as a book profit, then you need to file form 29B. So again, a certificate from the CA. In case of AMT is 29C. If you have entered into a slum sale transaction, you have sold any undertaking under slum sale, then a form 3CA is to be furnished. The certificate of CA of computing net worth of the undertaking. And for foreign remittances, do the form 15CB, which is certified by the chartered accountant, who gives the rate at which the tax is to be withheld before the remittance on such remittance. The government trusts the competency of chartered accountants. So there was a case of the Delhi High Court, the case of J Engineering. What happened in this case, I think, is that the books of account was lost, or it got burned out in the fire. Then the court allows the deduction on the basis of the tax audit report furnished by the chartered accountant. It says once the report is furnished, it substantiates that the expenses was claimed on the basis of evidence. It is certified by a chartered accountant, and that certificate has a lot of value and it cannot be ignored. And only basis such certificate the deduction was allowed. So this is a trust which the judiciary place on our certificates. In audit, there are part 1 of the second schedule, clause 7 and 8 says that individual shall be guilty of the misconduct of the professional misconduct if he signs, he gives a certificate or a audit report without proper due diligence, or without scrutinizing the evidences required to give such an opinion, or the evidences so scrutinized so obtained were not sufficient enough. So tax audit. See, the tax audit report. Okay. Tax audit report is given in two forms. Form 3CA oblique 3CB plus 3CB. So 3CA oblique 3CB means either 3CA applies or 3CB applies. So when 3CA applies, 3CA applies when the books of account of assessee are audited under any other law as well. If, say, assessee is a company or LLP, then the Companies Act and the LLP Act require the audit. Then, in such case, if you are doing a tax audit of a company or LLP, then you will issue Form 3CA, because the books of account of assessee are audited under any other act as well. But if you are doing an audit of any entity whose books of account are not required to be audited under any other act, then you will give a report tax audit report in form 3CB. Okay, you understood? So either 3CA or 3CB. But whether you give a report on a 3CA or 3CB, the report shall be accompanied by a form 3CB. It's actually the detailed tax audit form. Okay. Well, the difference between 3CA, 3CB is that if I tell you, 3CA is applicable to the assessee whose accounts are audited under any other law as well, while 3CB is applicable to the assessee whose accounts are not required to be audited under any other law. More important is that in the 3CA, the tax auditor does not give an opinion on the fairness or truthfulness of the books of account of assessee, because this opinion was given by some other auditor in some other law. But in the 3CB, the tax auditor gives such opinion, also comment upon the fairness or true view of books of account of the assessee. Let's discuss when the tax audit is required. Let's say 44AB. It says 44 under 44AB. We'll discuss in a minute because you already know that it's under the PGPP. A tax audit is required if the turnover of the business exceeds 1 crore. However, if the gross receipts to the cash receipts is less than or equal to 5% and the cash payment of the total payment is less than or equal to the 5%, then this 1 crore limit shall be substituted by the 10 crore limit. So, out of the total receipts, not only the turnover, total receipt, whether revenue or capital, whatever, if cash receipt out of total receipt is up to 5%, plus cash payment out of total payment is up to 5%, then you are required to get the books of account audited under section 44AB only if the turnover exceeds 10 crore. Payment was received through bearer check or the cross check. In case of profession, the audit is required if the receipts exceeds 50 lakh. If you're doing a business which is covered under section 44AE, the transportation, BB, or exploration and other turnkey projects, and you offer the income below the presumptive amount, the presumptive income, then also you're required to get the books of account audited. If you are doing a specified profession, if you offer an income below the presumptive income and your income exceeds the basic assumption limit, then also you are required to get the accounts audited. If you are subject to 44AD4, 44AD4 is what? You show the income less than the presumptive income, and then 44AD4 says that once you come into 44AD, you have to continue with the 44AD. If you want to offer your income less than the presumptive income, then such year and the 5 succeeding years. In all these 6 years, you pay tax under section 44AD or 44ADA. So there's a limit of 2 crore, 3 crore as the case may be in 44AD. So even though limit exceeds 1 crore, but if you opt for 44AD, audit is not required. Similarly, there's a limit of 75 lakh in the 44ADA. Even though limit exceeds 50 lakh, audit is not required if you opt for 44ADA. For 44B or 44BBA. B for the shipping, 7.5% of BBA is the aircraft 5%. Now, what do we mean by turnover? Sales. 1 crore, 10 crore, 2 crore, So, there's a guidance note on 44AB, the tax audit. We will discuss clause by clause the entire Form 3CD. There are 44 clauses. So first, the guidance note gives us guidance on how we compute turnover. So we will not include any discount which is there in the sales invoice itself. Okay. So the discount which is given as a part of invoice, which is stated in the invoice itself, doesn't form part of the turnover. But if there's a cash discount, if it's stated in the invoice, then not a part of turnover, but it's not stated in the invoice, then a finance charge, then it will be included as a part of turnover, and it as an expense, you can claim it separately in the P&L account. Turnover discount, similarly, if it's given in the invoice, generally given in the invoice, then not part of turnover. Special rebate, if it is in the form of trade discount, then not a part of turnover, but if it's a nature of a commission to this year or to the earlier year. Even if the goods sold were for earlier year and they are returned this year, the sales return will be reduced from the current year turnover. Okay. Of course, sale proceeds of the capital assets are not treated as a turnover. So if you force share debenture and the same proceeds are there in your P&L account, but if the shares or debenture were held as an investment, then the same proceeds shall not be counted for as a turnover. But if the shares or debenture were held as a stock in trade, then of course the same proceeds shall be included as a part of turnover. Similarly, gross receipts is not defined in the Act, but the guide does not say that it will include cash assistance, drawback in the form of duty drawback, commission. If there's a reimbursement of expenses incurred, then only the surplus shall be treated as a gross receipts, net exchange rate difference, liquid damages, etc. All part of say of scrap, advance amount if forfeited, and value of any other benefit or purchase shall form part of gross receipts. Okay, when you have a more than one business, so in income tax we go pan wise. If there's more than one business under single pan, then turnover of all such business shall be aggregated. But if you are opting for a presumptive taxation in respect to some of the business, then of course turnover related to such presumptive business shall be excluded. So we have discussed the difference between 3CA, 3CB. 3CA, when the books of account of SSC are required to be audited under any other law, then 3CA. Is not required to be audited, then 3CB. Under 3CA, it is not required for the tax auditor to give opinion as tax audit report. Can a tax audit report be revised? Yes, it can be revised. How many times? Any number of times. But it can be revised only up to the end of assessment year. What is the need? Why there's a need of revision of tax audit report? The need may arise. See, there are some sections which allow the deduction if the amount is paid up to due date of return of income. So, as make some payment of the before the due date before the furnishing return of before furnishing the return of income, then such expense should be allowed under section 43B because it has been paid before the due date of return of income. So this may require the revision of tax audit report if already issued before payment of this expense. Maybe there may be some tax audit report can be revised only by the same chartered accountant who had earlier issued it. He has to issue a new UDI. Okay. Okay, there are some points regarding to the tax audit report. It's important, है where there's any reporting, there's a complete, then we will report under both the cost and give a cost reference. If there is a difference in opinion between the client, between the assessee and the tax auditor, then tax auditor would state if tax auditor or the assessee is relying on some of the judicial proceedings, some of the case laws, then it is recommended, it is necessary for the tax auditor to quote such case laws, to state such case law in the audit report as well. If assuming the law has changed, but the form 3CD, the form has not been updated, then the tax audit report the form shall be filled based on the new law, not based on the form. The law shall prevail, not the form. The name as on the last day of the previous year and state this fact of the change. Address, you will state the address of the assessee, and the address is recommended to be same as in the income tax records. PAN. So there can only be point is VAT. You have to state all the registration number of all this. If there are more than one GST number, you have to state all GST number in the different states which the assessee has. Status. Status means the status of the entity, not the residential status. Status means whether the assessee partnership, company, LLP, because of the offender section 44ADA, or you are covered by 4484, as the case may be. In point number 8, in clause number 8, you have to state the time of tax audit, whether you are going for new tax regime. You have to state it here. If subsequently the assessee changes its mind, then you can revise your tax audit report. But it's better you take a certificate from the management about the regime which it intend to ask. Firm or AOP, you have to state the name, address, and the percentage of profit share of the partners members as the case may be. In point number 10, you have to state the nature of the business. You just state the principal line of the business. And if there are more than one line of business, you state all these lines of the business along with the codes. Is there a change in the nature of the business? You have to state the fact that there's a change and what is the new business. You have to state whether the assessee was required to maintain books of account 44AA or not. So you have to state this fact whether assessee is required to maintain. Then in the clause 11 books which you have examined. Not only this, you have to also state the place where these books are maintained. If these books are maintained in a computer server, then the point 12, you have to state the profit or loss, if any, of the presumptive business being included in the P&L account. You just need to provide the profit of such business which actually being included in the P&L account, not the profit which is to be taxed, which is accessible under those sections. If there is a presumptive business along with other business, the profit of that presumptive business, which is actually being included in the P&L account, we just have to state that income. So they're actually being credited to the account. If there's a change in a method of accounting, I have to state this fact and also provide the impact on P&L in the change in impact on profit due to this change. I also have to state the impact on the profit due to the ICDS. So if you see AS2, ICDS and ICDS2, the AS2 requires the valuation of stock on cost to NRV computed based on security wise, while ICDS requires the valuation category wise. So there may be a change in the valuation because of this, resulting into a change in profit. So you have to give this fact that there's a change in valuation and this is a change in profit due to this change. All disclosure as per the ICDS has to be stated. Then clause 14 is about the method of valuation stock and in the methods. Cost, all this fact has to be stated in the clause 15. Then clause 16 is important. It says that any income which has not been included in the P&L account is need to be reported in clause 16, though it's taxable. So these benefits are in kind. Any drawbacks, any escalation claim accepted during the previous year. This statement and the cash book of the assessee and all receipts, whichever are not taken as a part of income, has to be considered. Clause 17. So clause 17 says if any asset, if a land and building or property has been sold for a value less than the stamp duty value. So if you know, there's a section 50C or 43CA which says that if the stamp duty value exceeds 110% of the consideration, then a stamp duty value is treated as a consideration for the purpose of capital, PGBP as the case may be. So if any land or property has been sold for less than a stamp duty value, then all these factors, the address of the property, the stamp duty value, the price for which it is sold, is to be stated as a part of clause 17. Then clause 18 is the depreciation clause. Here you will state everything, the opening WDV plus the addition made, the date of addition, the depreciation for the year, and the closing WDV. The opening WDV, of course, should match with the closing WDV of the preceding year, which was furnished in the return of income. While giving the addition amount, the figure of addition, you have to take care of the subsidy. When the subsidy is granted, then that amount is reduced from the actual cost of the asset. 19 is you have to give a amount allowed under all this section which relates to scientific research, agricultural expenditure, the preliminary expenditure on exploration of oil, and etc. 20A, 36.12. If any bonus or commission is paid to employee which in lieu of dividend, then this fact has to be, the amount has to be stated under this clause. If any amount is deducted from the employee as employee contribution to PF and not deposited before the 21. 21 gives a list of lot of expenditure which are not allowable. So any capital expenditure, any personal expenditure, all these expenditure are stated here, which are not allowed, which are not to be allowed under deduction under the income under PGPP. Any penalty of fine within the contravention of a law, not a contractual penalties. All these things. Any disallowance under section 40 AI for non-deduction of TDS, etc. Any remuneration exceeding the limit of any remuneration to a partner exceeding the prescribed limit of section 40 clause B. Any deduction, any disallowance under section 48(3) for making a cash payment exceeding 10,000 or 35,000 as the case may be. All these things are reported here. 48(7), any amount contributed to a fund which is not approved. 47 or 48(9). Under 47, there is a gratuity fund. Under 49, there are other welfare funds. Any contingent liability, which is actually claimed as deduction, shall not be allowed. Then provision 14, provision section 14A, which says that any expenditure incurred to an exempt income shall be disallowed. So the amount which is to be disallowed in section 14A is stated, and which is not allowed as deduction. And under section 36 is to be 3 is not allowed. The amount of interest which is to be payable to MSMED, which has actually been debited to P&L account, is stated under this clause. Then this clause also requires the disclosure of the amount of in respect of any amount payable to the MSMED which was not paid within the due date as per the MSMED Act. Here you have to also see the disallowance of section 43B clause H. What does the clause H say? Clause H says that if any amount was payable to the MSMED and it is paid beyond the due date as per the MSMED Act, and it was payable as on 31st March, then such amount shall be disallowed and shall be allowed only on the payment basis. The option to claim the deduction up to the due date of return of income is not available for clause H, if you remember. Then 23B says any gives the amount paid to the relative to a specified person and the actual arm's length price of such amount. Then 24 provides, in the clause 24, you have to give a deemed gain under section 33AB or 33ABA. Then under clause 25, we need to disclose the income taxable under section 41 if there is any cessation of liability. Then 26, there is a disclosure about under in respect of section 43B. So under 43B, there are two types of disclosure. One, there may be a liability of the earlier year which has now been paid, so has to claim deduction in this year, and there may be a liability of this year which has not been paid, so has to be disallowed. So there are two parts, A or B. In A part, we claim the deduction which is not there in the P&L account. In B part, we disallow the deduction which is there in the P&L account. We're doing this very fast because you already have studied all this in your PGBP chapter. Clause 29A says that if any amount has to be included in the section 56 to 9, 56 to 9 is applicable on forfeiture of advance. So if there is any advance forfeited, then it has to be disclosed, it has to be taxed here. Then 29B is any amount taxable in section 56 to 10, the gift. Only the amount which has to be taxed is required to be stated under clause 29. So we are on clause 30. Yes, see, it's been done. We have come to clause 30, only 14 are left. So any amount borrowed or repaid on Hundi under section 69D, we just studied, has to be reported. Then if there is any primary adjustment, the clause 30A, the nature of the primary adjustment, whether a secondary adjustment was required on that account or not, it has to be stated under clause 30A and 30B. If secondary adjustment is not made, then the interest to be imputed has to be stated here. Then clause 30B is about the section 94B, where the interest is payable to AE, whether the interest is allowable or not. If it's exceeding 30% of EBITDA, that's not allowed. 30C is in respect of GAR. You have to state whether the assessee has entered into any impermissible avoidance arrangement. Then clause 31 is in respect of cash loan or deposit taken or repaid to sustain SS or ST or only T. Between SS to ST and T. You have to give the details individual loan wise. Okay. So clause 32. Give the detail of brought forward losses and depreciation. While giving the detail, we have to keep in mind the assessment order and the period order already passed, all the updated return furnished by the assessee. If there's a change in shareholding, then the loss is not allowed to be carried forward. Section 79. The fact of this is to be submitted. Then the speculative loss or the loss under specified business has to be stated separately. Clause 33 provides that amount of deduction allowed to the assessee under each section, section wise, has to be stated by the tax auditor. Clause 34 in respect of TDS. So here the fact that whether the assessee is required to deduct TDS or collect TCS is to be stated. If yes, then the TDS or TDS return furnished and the amount on which tax has been deducted, whether short deducted or not. All these things has to be stated by the tax auditor. Similarly for TCS, the clause 35 is it will require the details of quantitative details of stock. If you're trading concerned, then you have to give a detail of opening, purchase, closing, sold. If you are manufacturing concerned, then you have to give us details of raw material as well as the finished goods. The quantity wise. Clause 36A requires whether the assessee has received any dividend in the nature of deemed dividend 222E or in the nature of has received any buyback proceed, which is flexible under section 222F. Clause 37 says if there is any cost audit carried out, then state the fact that whether it's carried out or not. Clause 38, whether any audit was carried out in under the Central Excise Act. Clause 40 is important. Lists of various ratios, the net profit as well as stock turnover, etc., and it's compared to the previous year, earlier years. Clause 41, the tax auditor is required to give the amount of demand raised or refund issued to the assessee during the previous year under any act except the Income Tax Act or the Wealth Tax Act. Clause 42 in respect of the SFT, whether the assessee was required to furnish the SFT report. Clause 43 is in respect of the CBCR report, country by country reporting report. We have to narrate whether it was required or furnished or not. And lastly, the clause 44. This is a very important clause. It says it provides the GST RICO of all the expenses. So whatever expenses you have incurred, you have to classify those expenses into 4 parts. Whether expenditure relating to goods service was exempt from GST, or was it acquired, was it incurred from the entities fall under composition scheme, or it was expenditure relating to other registered entities, or total payment to the registered entities. All these facts has to be provided as a part of clause 44. We call it GST reconciliation. So as a summary, this is a table which provides the provisions, the sections which are being covered by in the tax audit report from 3CD. Which talks about 44AB, under which clause of 44AB the audit is required. Then talks about whether the assessee is taxable is opting for the old regime or the new regime. Then the presumptive sections. Then section 145, the valuation of closing stock. 45A, 45.2, the conversion of asset into a stock in trade. Any income which is not included in the P&L account but taxable under section 28. If the asset, any immovable property was sold for less than the stamp duty value, the fact is to be stated. The all details of section 32, the depreciation, and all this deduction has to be stated. Section 36.1.2 means the bonus or commission paid to employee in lieu of dividend. Then the employee contribution to PF, whether the same is taxable as dividend or not, we have to state it. Then we have to state any amount to be disallowed under section 37 in the nature of personal, capital, expenditure on clubs, etc. For any discount required for lower or non-deduction of, for short or non-deduction of TDS, any expense to be disallowed towards payment of salary or interest to the partner, any expense to be disallowed under section 48.3 for cash payment exceeding the limit of 10,000 or 35,000, the case may be. Any contribution to an unapproved trust shall be disallowed. It has to be stated. ICDS 10. Then any expenditure in respect of exempt income, which is to be disallowed in section 14A, has to be stated. Letter 613, any interest which should be capitalized shall not be allowed the deduction. Then interest payable to MSME is not allowed the deduction. Any payment to specified person, the fact and their arms and price has to be provided. And in deemed income in section 33AB or ABA has to be given. Any income out because of cessation of liability in section 41 has to be provided. 43B, the entire clause, the amount which is to be allowed a deduction this year and the amount which is to be disallowed under this year has to be stated. If it is 6 to 9, amount forfeited, and or if it is to 10, the gift amount has to be stated. Then the amount borrowed on hundi, then the primary adjustment or the interest paid to associated enterprise, the GAR provisions or the cash transactions, the carry forward of losses. Similarly, carry forward of losses, the amount of deductions allowed, the TDS provision, the dividend, to deemed dividend or the buyback proceeds, the CDCR. All these provisions are covered under section under the Form 3CD, the tax audit report. So if you do not furnish the Form 3CD in time, the tax audit report, then there is a penalty of 0.5% of turnover or rupees 1.5 lakh, whichever is less. The max penalty is 1,50,000. With this, we discussing sometime. Now, in exam, generally the case studies are asked from this chapter. The case study is for 4 to 5 marks, and maybe 6 marks also. So let's see what type of case studies are there. It's very simple. See, facts of the case is that now you only apply your mind and we have to answer whether the CA, the chartered accountant, is guilty or not of professional misconduct. Fact is that a search was conducted on the premises of a hospital, consequent to which it was found that hospital has made payment to consultancy charges to doctors without deducting tax. So hospital has made payment to doctor without deducting TDS under section 194J. Even though payment to the TDS to each doctor exceeded the threshold of 30,000. Okay. In the tax audit report, the amount inadmissible under section 40A was mentioned as nil. So there was no disallowance on this account in the tax audit report. Also, there was no mention of or reporting of TDS under section 194J for 34. So, of course, since the tax was not deducted, there was no disallowance proposed in the tax audit report on this account, and this fact has not been stated. Now, the question is whether the CA is guilty of a misconduct, professional misconduct. But when an opportunity to CA was given, he said that the payment to the doctor did not amount to expenditure as it was collected from the patient and given to the doctor. So it was not treated as expenditure, and therefore question of deducting TDS does not arise. Secondly, there was some case law, by the name Merlin Shipping, where I think Cochin Visakhapatnam Tribunal held that disallowance for non-deduction or short deduction of TDS is applicable only in respect of amount payable as on 31st March. Okay. So the CA said that I relied on this case law and therefore did not offer any amount for disallowance under tax audit report. But this case law was overruled by the Supreme Court decision and also by the CBDT circular. But all this Supreme Court decision and the CBDT circular was subsequent to the signing of the tax audit report. Okay. So now we have to decide whether the CA is guilty of misconduct or not. So first point is, the first defense is the expenses payment is not an expense, which is not right because they're in the P&L account. So this is not right. Secondly, even though there was a case law in favor of the opinion which the CA took, which the chartered accountant took, but the guidance not required if you're relying on a case law. The name of the case law has to be stated in the tax audit report as well as in the Form 3C or 3CB as the case may be. So since he has not stated this, and this is purely an expense which there in the P&L account, so the CA is a guilty of professional misconduct under clause 7. He has not done a due diligence. So in this case, he has ignored. He was held to be guilty of professional misconduct falling within meaning of clause 7. So case lot 2, it says that, okay, so there was search in the premises of a jeweler, and was found that the jeweler has purchased a lot of gold amounting to rupees 30 crore in cash from different customers. But the CA has not disallowed anything under section 48(3). Okay. What CA said that he had done the test check and the management has given a written instruction to the employee that no cash should be paid. He has relied on that instruction. And he has also taken a representation letter from the management that there was no cash payment. But if he had done a test check, then such a huge amount of purchase could not have been escaped from the test check. Secondly, only relying on the management representation letter or a letter by management to the employee without actually seeing the applicability or the followness, the follow, whether such letter has actually been followed in practice by the employees is actually ignorance, and therefore the CA was held to be guilty of professional misconduct under clause 7 and 8 of the part 1 of second schedule. Mere reliance on certification of management is not acceptable. He was held to be professionally guilty of professional misconduct. Now, case 3. Here, the CA gives a certificate and under section 80IA and was certifying that the assessee is eligible for a deduction under section 80IA. But subsequently, he realized that the period for which deduction is allowed has already expired. Once he realized, he immediately revises his certificate and asks the assessee, the client, to revise the return and withdraw the assumption deduction. The assessee revised the return and the assessment is made on the revised return. So it was held that C is not guilty of a misconduct because immediately he has revised the return, revised the certificate, has ensured that the return is revised, and the assessment has also been done on the revised return. So was held not guilty. Case study 4. Okay. In this case, the CA gives a certificate that the assessee is eligible for deduction under section 80IE. Though assessee was not doing any manufacturing, he was only packaging the goods. But since the term manufacture, what do you mean by the word manufacture is a litigative term, and a lot of meaning is there. There are a lot of judicial decisions interpreting this term, and therefore the CA may be given benefit of doubt, and he was not held to be professional. Benefit of doubt was extending to the CA, and he was held not guilty. Lastly, okay, a CA gives a Form 15 certified, Form 15 CB, gives certificate Form 15 CB, authorizing the remittance outside India without deduction of tax on the ground that the amount is to be paid for purchase of tickets, air tickets for the travel tickets. However, during the search or survey, it was found that no tickets were actually purchased and all was bogus invoices. Based on this, So, based on this, it was held that SSC is a CA is a guilty of a professional misconduct because he blindly issued a certificate only relying on the invoices without actually seeing the agreement between the remitter and the assessee. What happened? The laptop has hanged. No worries. So this completes our chapter. This also. And these two chapters which we covered, we tried to cover exhaustively from the module itself, you know, in 3 hours. Generally, and it's most likely that at least one question from either of these two chapters would be there in your exam of 4 to 6 months. So very simple chapters. If you spend one more hour for doing the question, the actual question, है ना, these two chapter would be मतलब पक्के हो जाएंगे आपके लिए, है ना. You will feel very confident in this chapter, and 4 to 6 mark will be very easy to secure. So if you like the video, do like, you know, do press the thumbs up button, share it with your friends, and am there for any queries. And do ask me if you have any queries in direct tax or international tax. I will be there to help you. We will be much more happy to help you. Thank you for today's class. Thank you. Yes, sir. Good.